Hi there, everybody. Nuelle from Galaxy. I lead the venture team at Galaxy. I'm also involved in our sort of DeFi capital allocation strategies. I've got a great set of panelists here today. We're going to be talking about the venture markets broadly, the new sort of emerging innovations that are happening in, the digital asset and blockchain ecosystems. We've got, both investors and operators here to talk about some of the key issues as, we scale this industry and the opportunities in the market. So I'm going to pass to each panelist for 30 seconds to give a quick intro to you and your firm, and then we can get going.
All
Travis?
Right. Thank you, Will. I'm Travis Scher. I've been a full-time investor in the crypto space for about 10 years. In 2020, I co-founded a firm called North Island Ventures. We do both early-stage venture investing, and we also do public markets investing, all in crypto.
Hello. I'm Uma, co-founder and CEO of Succinct. We're a company that builds zero-knowledge proof infrastructure, and we power a lot of layer 2 rollups, Ethereum L1 scaling closely with the EF, and I've also recently been making a push to bring ZK more into real-world use cases.
And I'm Rich Shorten. I am the founder and GP of a fund called Silvermind Capital Advisors. We focus on sort of special situations and venture and seed stage investing in digital assets. I'm also a co-founder of an infrastructure company called Global Stake. I sort of have a very operator-centric perspective on the world, which I'm sure we'll get into here. I began my career in telecom investing, so I was very actively involved in sort of the birth of the internet in the late 90s and the early 2000s, and I see a lot of pattern recognition today to what that era looked like.
Okay, just to kick it off, we'll stick with the topic of unicorns for a moment and then see where we end up. Last cycle, say 2021, 2020, 2022, there was the emergence of a ton of unicorns on the equity side that were typically infrastructure businesses. So multiple custodians, you could highlight BitGo, Fireblocks, Anchorage, you had Alchemy, you had staking businesses like Figment and Blockdaemon get that title. Since then, we've seen very few new infrastructure businesses sort of reach that billion-dollar milestone for valuation. The new kind of age of unicorn businesses has been more, the Red Hot Pays, the BVNK is obviously negotiating recently with Coinbase, plus, Zero Hash as well at that kind of $2 billion mark. What does that say about the space and about whether the infrastructure is sort of developed enough that there's not any new players there? Do you expect to see more players at the infrastructure level get that kind of unicorn level valuation, or have we seen most of that play out?
Yeah, I would say that we've seen most, but not all of that play out. Like if we were to back up to 2020, the big problem that you had in blockchain infrastructure was performance, meaning throughput, cost, speed of transactions. That has been mostly resolved at this point. I would also say that the developer experience for building on blockchains has gotten much better, but there's still a lot of room for improvement there. The user experience for your average consumer, or if it's an enterprise use case, that's improved, but there's a lot of room for improvement there. Nonetheless, I would say that we're not all of the way there. I think that there's a lot of opportunity, specifically in privacy, which has been a big topic recently, and I think justifiably so, in identity, and for compliance purposes, but also to unlock different financial use cases. And also, I think the sort of 800-pound gorilla in the room is in cybersecurity. This is a problem that has not been solved mostly, although there have been improvements there too. So, if I had to use a number as a proxy, I would say we're like 65% of the way there on the infrastructure side, but there's still a lot of opportunity.
Uma, do you have a view there?
I think a lot of the stuff you mentioned around privacy and identity, obviously being in the ZK space, I think zero-knowledge proofs are very applicable to both of those things. And on the infrastructure question, I think I agree with the sentiment that a lot of the stuff has been built out. It's night and day, even as a developer from even 4 years ago, but you can always do more. Like, we still need more performance. I think ZK has come a really long way in the past 4 years in terms of developer experience and usability and performance, and all of that stuff needs to continue as this gets more and more integrated into the real world use cases like privacy, compliance, et cetera.
Richard, anything there?
I have a slightly different perspective. I have the advantage of more gray hair than a lot of people in the sector, right? And I do agree with the thesis that about 65% of the infrastructure toolkit has been built out. However, I think that where we are in this space is analogous to where things were in about 1998, 1999. And if, for those of you in the room who lived back then, if you were to say, what was the largest internet company? It was AOL, now dead. What was the largest telecom company? The growth one. It was WorldCom, right? I think that we're at the era of the WorldCom and the AOL in this space generally, and that means that the winners today, I do not believe, are the winners for the future. There's so much happening in so many layers of the stack that there are massive opportunities, both at the equity layer and the protocol layer, something I assume we're going to talk about later, that the winners have far from been decided in this space.
Yeah, I would say I actually totally agree with that.
Yeah.
It's more fun if we disagree. But yeah, I would say to reconcile our 2 points, right? Like I would say we're 65% of the way there in terms of having the infrastructure that we need to build, to really start to move significant portions of finance on chain. And then to develop, these other applications that people have talked about for years, whether they're in social media or gaming or AI. I mean, I still think there's a lot of opportunity there. But I also agree that that doesn't necessarily mean that the infrastructure that is most prominent today is what will eventually be utilized for the applications that really enable the space to scale.
Yeah, if HTTP came out today, it would be a token, and it has no value today, but is ubiquitous, right? So, I think that these are the types of questions that you're asking, that we're going to be addressing every day in the space, for sure.
One of the, I think, things I'll tease out of both your responses is, and as Travis pointed out, this kind of finance aspect versus the other parts of the space, so other applications. Obviously, I also sit here believing we have a ton of room to grow at the application layer. There's probably multiple, many billion-dollar businesses still to be built at the application layer. There's always a debate whether blockchains are about finance or about something else in general. And I think that informs the types of infrastructure companies that can get big and will continue to be big. Just so we set our kind of baseline, you, Travis, I think, believe that this is primarily about finance. I actually fall in that category as well, that the story with crypto is about the disintermediation of traditional financial services. Uma and Richard, where do you stand on that topic?
I think a lot of the blockchains are very finance-centric and better financial rails, whether it's for stablecoins or other types of trading applications and stuff like that. I do think some of the technology that's being built that's underlying all this stuff, like cryptography, though, can be extended beyond just finance use cases. So, for example, this identity compliance regime, obviously compliance has use cases beyond finance, or identity, passport, who you are, entering a country, stuff like that, is beyond finance. So I think some of the technological primitives we've developed have broader use cases, but a lot of the blockchain block space, I think, will end up being used maybe 95, 99% for the finance stuff that we know.
Yeah, I mean, I guess what I would say is I think I'm evenly divided between the two. I don't think that the future finance, I think that blockchain will be an integral part of future finance. So finance is the email of blockchain, right? Email was the application for the original internet, right? Now, obviously a lot more has happened, but to my sort of time horizon metaphor, I think that blockchain is at the era before AWS showed up for applications, before social media showed up. The drive of the internet infrastructure occurred in the early 2000s to 2010 when social media demand and SaaS companies and AWS all arrived to actually consume all of the stuff that had been built over the first, the prior 10 or 15 years. I think that we have yet to get to that stage with blockchain. We're starting, it's starting to happen, but it hasn't yet happened. And truthfully, financial applications may not be the biggest, demand drivers. AI applications are much heavier demand drivers of, utilization and block space, et cetera.
Yeah, I mean, the way I describe it is that crypto is primarily financial infrastructure. If you look at, what it does, it enables people to tokenize assets, to store those assets, themselves, to send those assets instantly anywhere in the world. And the killer use cases thus far are, there's Bitcoin as a non-fiat store of value, there's stablecoins, there's perp dexes. These are all financial use cases. But that doesn't mean that the only applications of this financial infrastructure is to financial services as an industry. I do think that you're going to see this financial infrastructure being used in a wide variety of industries over time. But many of the use cases that people have been hyped about for the last 5 years, they may take another 5 years to come to fruition.
To move on a little bit to another kind of change in the market landscape that I want to ask you about, it feels to us like there has been an increasing acceptance of investing in equity, just like pure equity from a VC perspective. I think a couple years ago, if you asked any crypto VC, they would say, I only invest in tokens, right? Do you guys agree or disagree that this market is shifting a little bit in terms of favorability towards equity? And then how do you think about it? Travis, you as an investor, Uma, you guys have a token. How do you think of some of the dynamics between the long-term compounding potential of equity versus tokens and where you would, place bets for you, Travis and Richard, and Uma kind of just manage your forward plans?
So I've been doing this for 10 years at this point, doing venture investing in crypto, and this is a pendulum that has very regularly swung back and forth. And essentially what happens is that when the public markets are hot, and in particular when the altcoin markets are hot, everybody is raising money to do a token. And you have, firms like ours that will say, we look at the historical returns, they all come from tokens. We're not even touching equity. I mean, you have people go to that extreme. But then eventually the pendulum swings back because the token market gets oversaturated, people launch too many tokens, the tokens are shit coins anyway, there's no demand for them, they go down, people are speculating on AI now, and meanwhile, people have built real companies in the space. And so we're seeing, 5 to 10 legitimate crypto companies go public this year. We're starting to see crypto M&A on a scale that we've never seen before. And so then, on the venture side, you probably have more activity on the equity side. I would say the lesson of the last 10 years is, maybe be a little counter-cyclical as an investor at the early stage on this front, and certainly, be skeptical of assuming that, basically extrapolating that the recent past is a great predictor of, the future for the next 5 or 10 years.
Go ahead.
Yeah, I think if you look at, for example, the Uniswap changes that happened recently with the Uni token, or even what firms like Succinct are doing with their token, a lot of these things are converging. And I think for a long time, there's this kind of conspiracy theory or that a lot of people like to speculate on, which is, founders of projects, they like having this equity entity and the token entity and basically double dipping. But I think in reality, if you talk to most projects and most founders, having this dichotomy was not ideal, and it was an overhang of this regulatory environment where you're very limited in what you could do with your token or say about it, or there's just a lot of people being scared. So I think now that there's going to be much more clarity, obviously there's this network token framework that maybe we'll see some legislation on soon, people can kind of reduce that dichotomy and just have this one unified thing that represents, their protocol or their company, and more of these things will converge, I think, rather than diverge. And structurally, they'll become much more similar. So in the equity markets, people care about PE ratios, revenue. I think in the token markets, people also care about similar things. And so I'm really excited to see, especially with like Uniswap and zk-Sync, more protocols going down that path. And I think there might not be a huge difference in when investors think equity versus token because they'll look very similar.
Yeah, I agree with that last point. I think there will be a conversion. I agree a lot with what Travis has said. The pendulum sort of swings back and forth. We're certainly at a stage where the pendulum has swung back in a different direction. I think that the sort of next phase here will be a little bit different than historically, even up until very recently, there was very, very poor analysis between what a token did and what an equity, the equity of the labs company did, and what the linkage was between the two. Companies could get funded with multi-$100 million valuations, and token could get launched with completely opaque and not even opaque, non-existent linkages between the two. Some of that was intentional because the lawyers, I was once one of those lawyers, the lawyers would say, well, you can't do something that's revenue generated because then it's centralized, and it intentionally created this, opaque dynamic between the token and the equity of the company that launched the protocol. I think that the new regulatory frameworks are going to make it a little bit easier to start to define with some precision what the token does, what the equity accrues, how the two are linked, and in fact allow investors in tokens to sort of pinpoint, okay, what does the token actually represent in terms of raw fundamentals, value-based economic model? Things like, Hyperliquid and others have sort of allowed you to start to do things like this. And I think that there's going to be a greater migration in that direction, with the end state being, as Oma said, the two will end up being, maybe different flavors of the same thing.
Just to follow up on this question, another thing that we think about a little bit internally is whether the access to early liquidity for tokens, and like in equity businesses as an investor, generally your exits are either an IPO or M&A. And so you exit with the founder. There's some caveats to that, right? With secondary sales that either could do on either side. But tokens have a whole nother dimension when you're investing, which is there's quick liquidity. Generally, if you're trying to build a unicorn, or a decacorn level, valuation outcome, it requires some degree of like multi-year, many-year compounding, right? Like, do you even think that with the path to early liquidity that's available for, for founders, team, investors, et cetera, that you can sort of break through at scale? Obviously, there have been cases where it's been done. Solana, Sui sort of has broken through to a 11-figure valuation. Ethereum, obviously, but like the cases of getting to sort of 10 figures and then down is actually more plentiful than sort of the upward direction. Do you think that's a fundamental constraint for protocols, token-based projects that is a limiter against valuation over the long run?
I'm not sure I even agree with the premise of the question. For example, in the AI market, which is very hot, OpenAI has these regular tender offers. They pay super well. I think a lot of early employees have participated in those tenders, and they're still working extremely hard because they're motivated by the problem and the mission. Yeah. So I think this early liquidity is not something that's just unique to tokens, and you see it in other markets. And ultimately, I think if the founder and the team is really motivated by the mission, then they will continue to drive results because they know that it's worth their time and effort because they can keep on compounding the value. Yeah,
that I disagree with a little bit. I think that some of the norms and incentives around token launches and liquidity and lockups in this space are just absolutely terrible. I think that. It's true that sometimes employees of large private companies can sell stock, right? But one of the big problems in this space is that there's absolutely no transparency into precisely how much of the token allocation founders have, if and when they might be selling or they may have sold. So if you were to look at the public equities market, right? If the CEO is selling stock, right? There's a lot of rules around how they have to do that. And so what you end up with is an incentive for the founders of the team to basically,
investors
and the investors too.
And
the investors too, right? With these short lockups to generate as much hype as possible, to drive the token price as high as possible, and to be selling at the same time that they're trying to convince the public to buy. And that should be illegal, right? I think it's totally
I think it's funny. I kind of agree with both of you. That phenomena is definitely true. It was very true in the past. Although you see the imposition of constraints coming from some of the unlikeliest of places, right? I'm sure everyone on the stage has experienced an early stage investment. You have a token vesting schedule, and then you get a call from the founder that says, hey, XYZ exchange says we have to change the token vesting schedule in order to even be able to get listed, right? And there's like a convergence occurring between constraints that still are not anywhere near where they need to be, to your point, Travis, in terms of the behavior constraints on early investors and protocol teams, sort of moving towards more traditional liquidity periods. They're still not there, and if you know how to access OTC markets, there's all sorts of stuff going on, there. But that world is migrating towards a more traditional framework, and at the same time, to your point, that probably everyone in this room gets some text message once a day, like you can get access to OpenAI or Anthropic. Here you go. Put in $10,000, and after a 5% fee and a 4% fee and a 7% fee and an 8% fee, then you can participate at a gajillion-dollar valuation, right? Like those things are starting to converge, and I think it's crypto rails that are going to allow that fee friction to be eliminated, and it's the entry of like real serious capital that's going to just not deploy until some of those governors are in place, the kind that Travis is saying, are really, really early, aren't there yet.
Just a last quick one on this topic before we move on. Like net, I'll pitch it to each of you. Is this dynamic with tokens and early liquidity more of a hindrance or a help to like long-term valuations and compounding? Travis, you seem like your take is hindrance.
I think it depends, right? I think that, one of the functions of a token is growth.
Yeah.
It's incentivizing early participation. It's building a community. I think probably the most straightforward example of this is in DePIN, for example, right? Where the purpose of the token is to create the network that provides the service. So without the token, you don't even get the service. Yeah. But I think that, the liquidity that founders have and investors to some extent tends to be way too fast. And again, the lack of transparency is the huge problem. Like there needs to be limitations around and transparency around insider sales of the tokens.
Any other comments, guys? Otherwise, we'll move on.
No, just one thing I'd add is I think the serious founders are grappling with these issues. It's the serious crypto founders and the serious investors are grappling with issues like this real-time, every day. I agree, areas like DePIN. There's a project named Dawn that we're invested in that's a big, hot DePIN project. And I was with the founder earlier today who's grappling with exactly these issues. How do you balance responsible transparency, timing of token, equity growth, et cetera? Like the serious founders and the serious capital behind them are grappling with these issues every day, and I think that's where the durable unicorns are going to come from. I think we've had 12 unicorn crypto projects thus far this year that have launched, and almost all of them with no revenue, right? Like unicorn means a lot less today than it used to mean, but durable unicorn is like what we want to see, ones that will last for a couple of years at least.
To move on to market segment, so obviously we're talking about unicorns, the potential to build big businesses and innovate in the space. We talked about infrastructure originally. Now it feels like at least we're focused on the shift towards application layer opportunities. We're very focused on stablecoins, payments, tokenization, areas like that. What segments of the market do you guys think are particularly ripe to build big businesses today? It's possible that the billion-dollar businesses of next year have already been founded, and so we're talking now, 2 or 3 years or 2 or 3 years out. But I'll give you guys a couple prompts: stablecoins, DeFi, asset management broadly, prediction markets, the convergence of crypto and AI, launch pads, alt L1s. Where, if you had to weight certain categories versus others in terms of their ability to create new big opportunities, where do Uma, ZK, where do those opportunities lie in your view? Maybe, go ahead.
Yeah, so I think if we were to start with like the more boring, less sexy finance use cases, I think that the stablecoin space is pretty saturated at this point, right? We have 300 billion in outstanding stablecoins. It's basically a duopoly. It may be that some incumbent traditional financial services or fintech company, big fintech can move in and take meaningful market share. PayPal tried, they didn't get anywhere. Maybe Stripe will have more luck because they have some better distribution advantage. And there's a bunch of unicorns in that category. I think in finance, the category that is going to be as big or bigger is the tokenization of securities, and that's much more nascent, right? Because there, I think the total value of all the tokenized securities, depending on how you count it, is maybe $30 to $50 billion. I mean, it may depend on whether you count some of these can't on subnets, for example, or whether you count the tokens on
For
Figure.
tokenized equities, it's like $500 million, right? It's quite small. But tokenized securities broadly, I think it's like 30 billion, inclusive of all the Figure HELOCs, essentially.
Yeah, so that category, I mean, I think it's totally plausible that that category can grow 100x or more in the next 5 years, right? The 100x would be 3 trillion, which is less than NVIDIA's worth. So, you know, and again, it's interesting. It'll be interesting to see how it plays out because there is the opportunity there for incumbent traditional financial services companies, some of the incumbent crypto companies that are now quite large, like Coinbase and maybe Figure and others, and startups. I mean, we have some, you know, pre-unicorn startups, as I think you guys do, who have amazing teams and really interesting plans to get there. So that's a category I expect to grow massively.
I think privacy is a really big area, and even within the stablecoin space, if we think that today there's maybe 200, 300 billion of stablecoin issuance, that's going up 10x. It seems ridiculous that all of that stuff would be public and transparent. So I think there's a huge need for privacy, especially as more serious institutional players and real world, actual real people start using this stuff. So that's one area I'm really excited about. The other area I'm excited about is crypto x AI, but not in the AI agents are going to use crypto rails for payment, although maybe that'll happen. I think people like Balaji have written about this a lot. There's this opportunity for cryptography and blockchains to kind of be this digital scarcity ledger of record, and AI makes everything abundant. You don't know what's real or fake. You can generate anything by typing in a prompt, and I think there's an opportunity for attested hardware, attested devices, and proofs to prove what's real, prove what's authentic, and kind of be this counterbalancing force to the AI stuff that's going crazy right now. So those are the two areas I'm most excited about.
In the privacy space, since I'll kind of dig in just quickly on that, like, are there any, like, there's obviously a lot of different techniques. You do ZK, there's FHE techniques, there's just pure encryption. Like, how does that practically get done? Let's say for stablecoins, because it's a relevant use case where people are passing payments and they need to do it in a private capacity. Are there any, like, subsections of that privacy market that you feel like really bullish on that maybe not appreciated? Obviously, you're an expert in this category.
Obviously, I'm biased because we do a bunch of ZK stuff, but I think the ZK tech is honestly mostly ready from like a developer experience, cost, latency perspective. It's really about packaging it up in a really nice UX. So when I think about, you know, how the last generation of wallets was really clunky and bad, and something like Privy made it very easy, and you can log in with your email. You don't have to worry about this private key management. They kind of took the tech and put it in a really nice package. I think there's an opportunity to take all the ZK privacy tech and put it in this nice package where everyday people can start using it everywhere. And I think someone who does that well will end up being very successful.
And by the way, tokenized securities and privacy are kind of, you know, a requirement to be paired together as well for obvious reasons. Institutions aren't going to do tokenization without privacy, generally speaking.
For sure, I agree. And I think the core, again, using sort of the mistakes, the things I did right and wrong 20 years ago, I think, you know, inform the way I look at the world today. I think that simplicity really, because I think that the big unicorns and the real big opportunities come from companies that can take all of this complicated stuff. We've heard a whole lot of finance acronyms, I mean, how many people in this room truly understand FHE, ZK, other privacy techniques, et cetera? I'm willing to bet it's less than 10% even know like what these dynamics are, right? The value accrual, there's a lot of technology and a lot of opportunity here. The ones that can package it and tell a simple story, if you're talking to consumers, do it really simply and pretty. If you're talking to institutions, do it simply, maybe even simpler, but do it in a great regulatory wrapper with all the boxes checked to every layer of the infrastructure stack. That's where the winners are going to be. So we're tying this stuff together in a bow to make it understandable to the capital deployer who wants to move meaningful amounts of capital into the space or has some innovative technology that they want to bring onto platform, right? Getting in front of the the government contractors, which is critically important for, ZK protocols, et cetera, right? Because they're dealing with lots of private things, supply chain things. Like, that's going to require you to have this sort of both combination of simplicity and a very, very robust infrastructure stack that meets, institutional requirements.
We've got about 30 seconds here. Anybody want to venture a bet on the other side of the question, the flip side, which is things that are theoretically worth a lot today, but are sort of fragile, or you think are kind of have no equilibrium or terminal value? Like segments of the market that you think are sort of overpriced, overappreciated today. I mean, crypto's famous for blowups after all, right? At least in the last 5 years. So if you had to project where the next blowup comes from, Travis, you're milling on this, I can tell.
Yeah, I don't know about the next blow up. I mean, it would probably be one of these DAT companies, but that really has nothing to do with the technology or what's interesting about anything in this space. I think that a better answer is probably the biggest L1s today. I don't think are actually well positioned for the future. I mean, I would not be shocked if Ethereum is worth less than 5% of what it is today in 5 years.
Wow. Okay.
Yeah. I concur with that. I don't know about the 5%, but I concur with that view generally. I think that block space is ubiquitous. It's available everywhere. Ecosystems have value for sure. Ethereum has done a great job of holding on to an ecosystem because a lot of capital is deployed there. And by the way, it's hard to get capital out in many cases too. So, I think that, now the metaphor I use for block spaces is kind of like water. Available everywhere, but it's really, really valuable if you get the right type of water in the right place and time, right? That's what's important about water. If you're in a desert, it's really valuable. If you're in a stadium full of people and you can sell the water, it's very valuable. I think that the L1s that have not already built an ecosystem, and there's a very significant one today, Canton, that's a meaningful player here. They've done a fantastic job of building the ecosystem. The ecosystems are what's going to matter. The rails matter, a little bit less.
Any final thoughts, Uma?
I'm still bullish on Ethereum. I mean, obviously, we work very closely with them. But I do agree that this trend of, the alt L1s and this L1 premium and things like that, I think, is on the decline and will just continue to do so, especially as people realize, we've already built these networks, and now you can deploy L2s on Ethereum. Block space is easy, free, and cheap. So why do we need more?
Yeah. Okay, give a round of applause for the panelists. Thanks, everybody.